The specific lever that kept this.
And the decision to adopt a Bitcoin 11x and negative point file an S4 registration statement on January 15th.
$70 million in combined cash and digital assets.
For anyone analyzing the situation or highly speculative leap.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
$5.50. That is exactly where Ryvyl Inc., trading under the ticker RVYL, is hovering on the tape right now. We are looking at a current market capitalization sitting precariously between $5 million and $7 million. And to understand how we even got to this exact pricing, you really have to look at the critical survival mechanism, the specific lever that kept this entity publicly viable on the exchange. I am talking about the 1-for-35 reverse stock split they executed on January 1, 2026. For those tracking the regulatory side, that structural adjustment was an absolute necessity. It allowed the stock to maintain a closing bid above the $1 threshold for 10 consecutive business days, running from January 2nd straight through to January 15th. By pulling off that maneuver, they successfully restored their NASDAQ compliance and bought themselves time.
Time, yes, but at what underlying cost? Because if we look under the hood of that specific price action, the corresponding short metrics tell a rather harrowing story about market sentiment. As of March 2nd, 2026, the total short interest sits at 103,555 shares. Now, post-split, that represents 12.58% of the entire available float.
Right.
But the number that really jumps out is the off-exchange short volume ratio. It stands at a staggering 53.23%. When you pair that with a grueling 9.58 days to cover, meaning it would take almost 2 full trading weeks of average volume for short sellers just to buy back their positions, the picture becomes very clear. Make no mistake, the price action we are seeing around that $5 mark is occurring under immense, heavily concentrated speculative pressure. The market is actively betting against this company's survival.
Which brings us to the actual foundation of what we are analyzing today. Because this isn't just a story about a struggling legacy business trying to stay afloat, we're examining Ryvyl's $75 million reverse merger with RTB Digital, which operates as Roundtable. This represents a massive structural pivot away from their historical payment processing business and directly toward a Web3 media ecosystem, one that is explicitly backed by a Bitcoin standard treasury.
Exactly.
So, the fundamental tension we have to navigate is this. Is this drastic transition a deeply undervalued, highly asymmetric growth opportunity that the market has completely misjudged? I will be representing the stance that it absolutely is a massive opportunity.
And I will be taking the opposing view, arguing that this is a highly dilutive, precarious, speculative play that is essentially using blockchain buzzwords to mask years of historical operational failures. That is the philosophical and financial divide we need to unpack today, because those two interpretations lead to wildly different valuations.
Let me outline my thesis on this straight away. I believe Ryvyl is profoundly, almost absurdly mispriced by the broader market right now, and I am looking purely at the metrics. Currently, the stock is trading at a forward price-to-sales ratio of just 0.07x. To put that multiple into human terms, the market is valuing the company at literal pennies on the dollar of its projected revenue.
Yeah, but
Year average is currently sitting at 4.2x. Ryvyl's own 5-year historical average was 5.72x. So the market is demonstrably pricing Ryvyl as a completely failing dead-end legacy business. But that assessment completely ignores the mechanics and the capital infusion of this upcoming merger. We are not just talking about a name change. We are looking at a hard asset infusion of over $30 million in Bitcoin plus $43 million in raised capital coming over from Roundtable. That creates a profound, undeniable disconnect between a sub-$10 million market cap and the combined pro forma net asset value of the new entity.
well, sure, if you ignore the mechanics of
And if you need a proxy for smart money, look at the $10 million investment from UTXO Management. That was executed at a $200 million pre-money valuation. That is a massive signal. It serves as irrefutable proof of institutional confidence in this Web3 pivot. Sophisticated blockchain investors are essentially valuing this combined entity at nearly 30 to 40 times its current public market capitalization.
I look at those exact same numbers and I come to a fundamentally different conclusion. The narrative of a 100% upside here, this idea that the market is just broadly getting it wrong, willfully ignores catastrophic dilution and deep fundamental operational distress. To actually consummate this merger, Ryvyl had to file an S-4 registration statement on January 15th. That document detailed the impending issuance of over 14.28 million post-split shares.
I know the math is tough there.
It is brutal. Look at the math on that. Current Ryvyl shareholders, the people holding that $5 stock right now, are going to see their slice of the pie shrink drastically. They will be crushed down to a mere 15.15% stake in the new company, while Roundtable effectively absorbs 84.85% of the combined entity. That is a brutal cram down. Furthermore, layering a highly volatile asset like a Bitcoin treasury onto a company with a history of weak profitability, negative margins, and a deeply troubled legacy balance sheet, that is a desperate financial maneuver.
I disagree it's desperate.
It is not a structural cure for a broken business model. You cannot simply bolt cryptocurrency onto a distressed, cash-burning asset, change the ticker, and suddenly call it a high-growth opportunity. The market isn't mispricing Ryvyl. The market is efficiently pricing in the dilution.
I completely understand why the dilution is the immediate red flag for you. It is a bitter pill for legacy shareholders. But let's contextualize that valuation mismatch against the dilution you were talking about. Even if we accept the cram down, let us look at the combined balance sheet post-merger. We're talking about an entity that will be holding over $70 million in combined cash and digital assets. Even with the expanded float, if the stock were to simply trade at 1 times its net asset value, literally just 1x NAV, offering zero premium for the actual operating business, it would still require a multi-100% price increase from current levels.
Assuming the assets maintain their value.
Right, but the market is applying a discount that borders on the putative. And when you factor in the technical setup on the tape, the vector for a massive short squeeze becomes highly probable. We just talked about the short metrics. We are looking at borrow fee rates ranging between 129.21% and 152.50%. When you have borrow fees that high, short sellers are bleeding cash every single day they hold their position. Combine that with the 32,963 fails to deliver that were recorded on January 14 alone. A fail to deliver means the system is literally breaking down in its attempt to locate shares to short. The upcoming March 18 special meeting of stockholders is a definitive binary catalyst. If the stockholders approve the merger agreement and the transition to the RTB ticker, that single legally binding event could easily trigger a cascade of panic covering from short sellers who are currently trapped paying exorbitant fees.
The mechanics of a short squeeze are always enticing, but I have to stop you there because I simply do not buy that thesis as an investment strategy. You are prioritizing the speculative math of a potential short squeeze over the harsh, permanent mathematical reality of the float. Yes, borrow fees are high. Yes, the fails to delivers indicate a tight borrow, but you have to step back and look at the sheer volume of paper that is about to flood this market. Alongside those 14.28 million merger shares we discussed, we have to account for the conversion of outstanding convertible notes.
Those are known factors.
Known, but toxic. That toxic debt spiral could add another 8.2 million shares to the count. We also have a Series C preferred investment of $6.5 million sitting heavy in the capital stack, waiting to be resolved. This is why institutional analysts who actually model these specific dilutive effects, rather than just looking at technical squeeze setups, are deeply skeptical. Weiss Ratings currently holds a firm sell on the stock, and H.C. Wainwright maintains a cautious neutral stance. The enterprise value of this company must scale exponentially just to maintain the current $5.50 share price in the face of this terminal dilution. A short squeeze might offer a fleeting technical spike for day traders, sure, but the structural weight of over 22 million potential new shares entering a micro-cap ecosystem is a gravitational force you cannot ignore. Gravity eventually wins.
That is a fair warning regarding the float, though I would frame the dilution differently.
The dilution is a quantifiable variable. The market already sees the S4. It is essentially the upfront cost of acquiring a highly scalable, modern operational engine. Let's pivot away from the financial engineering for a moment and focus on the actual business. Let's talk about what RTB Digital brings to the table operationally with their Web3 media model. They aren't starting from scratch. They have built the elite journalist network. This platform has already onboarded over 150 premium media professionals, including notable former Sports Illustrated writers. And we have concrete, undeniable evidence of its efficacy. Take their top contributor, Mike Fisher. He is reportedly generating $4 million in annualized revenue on this platform alone.
One creator.
Beyond individual creators, Roundtable has secured a $15 million 10-year partnership with the Hockey News. This isn't just a theoretical white paper. It is a proven, functioning decentralized media liquidity pool. Furthermore, the leadership team stepping in post-merger is exceptional. We have James Heckman taking over as CEO. He is a serial media entrepreneur with a formidable, proven track record at Yahoo, Fox, and MySpace. He is joined by Eyal Herzog, who founded Bancor and understands tokenomics deeply, alongside Bill Sorensen, formerly of Microsoft. This leadership trio provides incredible operational credibility to actually scale this network, especially when you consider their existing baked-in partnership synergies involving Yahoo, PSG, and Miss World.
Tiger by the tail, regarding their own 2026 IPO preparations, it highlights the immense escalating value of high-traffic digital media assets right now. Roundtable is positioning itself to be the primary Web3 infrastructure for these exact types of Tier 1 assets.
The pedigree of the leadership is certainly a talking point, and I acknowledge James Heckman's historical successes. But we have to evaluate the actual scalability of this platform and the timeline required to execute that grand vision. Highlighting Mike Fisher's $4 million in annualized revenue is impressive in isolation. It makes for a great press release. But assuming that his specific, localized success can be uniformly replicated across a network of 150-plus journalists is a massive, highly speculative leap. Media is notoriously difficult to scale profitably, and we must evaluate this ambitious future against the very real historical operational performance of the underlying company. Ryvyl's trailing revenue of approximately $35 million to $56 million did not come cheap. It came with significant, persistent cash burn. We are looking at a trailing price-to-earnings ratio sitting somewhere between negative 0.11x and negative 0.4x. They were bleeding money. Changing the corporate name to RTB Digital and securing a shiny new ticker symbol does not instantly resolve deeply entrenched negative operating margins. It does not instantly create operational efficiency out of thin air. Integrating a cutting-edge, decentralized media platform with a legacy digital payment infrastructure that was already struggling is an incredibly complex engineering and corporate integration challenge. The execution risk here is monumental. And again, the market's heavy discount is simply reflecting that reality.
I hear your skepticism on the integration, but I believe that line of reasoning treats the Web3 components, specifically the Bitcoin treasury, as a passive, detached gimmick, rather than an integrated operational tool. Let us really delve into the DA-TCO model, the digital asset treasury company structure they are deploying. Roundtable is not just hoarding $30 million in Bitcoin on a cold wallet and blindly hoping the macroeconomic price goes up. They are actively building a utility around it. By creating decentralized payment systems that allow independent publishers to self-pay, they are fundamentally altering the unit economics of digital publishing. It removes the friction and the massive fees of traditional ad networks. Furthermore, they are integrating validator services and tokenized credit instruments directly into their infrastructure. Now, we know that pure-play Bitcoin holding companies often suffer from NAV discounts because their assets just sit idle. They are essentially closed-end funds, but RVYL and Roundtable are protecting themselves from that standard net asset value discount by ensuring their Bitcoin reserves actively facilitate and collateralize their Web3 media ecosystem. It is a working treasury. It provides immediate liquidity and settlement for those 150 journalists. It's an operating network, not a speculative stockpile.
But you cannot divorce a working treasury from the broader macroeconomic realities it exists within. and the decision to adopt a Bitcoin treasury model in early 2026 is fraught with systemic macro risk. We have to acknowledge the elephant in the room, the early 2026 crypto crisis and the subsequent brutal Bitcoin price correction from its 2025 peaks. Right now, as we speak, many established, well-capitalized DACTOs are currently trading well below the value of their holdings due to a widespread premium collapse in the crypto equities market. Adding the extreme volatility of cryptocurrency to a corporate financial state that is already characterized with an urgent existential need for capital, it compounds the risk exponentially. Even if management's vision of a self-paid decentralized protocol is technologically sound and beautifully engineered, they are ultimately at the mercy of macroeconomic crypto cycles. And if you want to know how the smart money is reacting to this specific risk profile, look at the recent institutional filings. Arena Investors LP, a serious, fundamental institutional player, reported a negative 100% change in their shares in February 2026. They completely exited their position. They walked away. When professional distressed debt investors abandon the ship and the ownership transitions heavily toward highly speculative Web3 funds like the S8 Global Fintech and RegTech Fund, who, granted, now hold over 3.6 million shares, it indicates a fundamental shift in the capitalization table. It is a transition from rigorous fundamental value investing to highly speculative, high beta gambling.
It is absolutely a high beta play, I won't deny that. But when we synthesize all these data points, my position remains firm that the sheer upside potential far outweighs the structural risks we've outlined. Yes, the dilution from the 14.28 million merger shares and the looming threat of the outstanding convertibles is a significant headwind. It is heavy. However, you have to look at the absolute floor provided by the math. The $30 million Bitcoin pledge, the $43 million in raised capital, and that critical $200 million UTXO valuation floor. Together, they create a highly asymmetrical risk-reward setup for the retail or institutional investor looking at this right now. We are looking at a microcap company with a public market capitalization of under $7 million that is, upon closing, about to hold over $70 million in combined cash and digital assets. It is trading at a fraction of its future cash on hand. When you factor in the immediate, intense technical pressures we discussed regarding the short sellers, the 150% borrow fees, the massive fails to deliver, the tiny remaining float, a 100% gain by year-end 2026 is highly probable. The caveat, of course, is that the Q3 closing must execute flawlessly, and the March 18th special meeting must proceed without any activist roadblocks. But if they execute, the upside is explosive.
And to summarize my stance, I maintain that the gravity of the capitalization table will ultimately dictate the price action. The mathematical reality of issuing over 22 million potential new shares between the S4 merger shares, the convertibles, and the preferreds into a fundamentally distressed legacy company creates an insurmountable headwind. The enterprise value required simply to tread water and keep the stock at $5.50 is staggering. Relying on a newly bolted-on crypto treasury during an ongoing early 2026 market correction is a highly speculative gamble. And frankly, it is a gamble that risks masking the historical, persistent operational failures of Ryvyl's payment processing business. The market is not blindly mispricing this asset. The heavy discount we are seeing on the tape is a completely rational, mathematically sound reflection of extreme execution risk, the deep uncertainty of scaling a decentralized media network, and the profoundly dilutive nature of the impending S4 issuance.
It is quite clear that we approach the valuation of this entire transition from fundamentally different analytical frameworks. One, prioritizing the asymmetry of the asset floor and technical setup, and the other, prioritizing the gravity of the dilution and historical cash burn. However, I believe we share complete common ground in acknowledging the timeline. The upcoming March 18 special meeting of stockholders, where the formal adoption of the RTB digital name and the merger agreement will be put to a vote, and the anticipated Q3 merger closing are the definitive binary events for this company. They will dictate its survival and its future trajectory.
We absolutely agree on that timeline. The mechanics of valuing a microcap company that is attempting such a highly complex bridge trying to connect traditional legacy fintech with a decentralized Web3 media infrastructure is a fascinating stress test of market efficiency. For anyone analyzing the situation or considering a position, it will be absolutely critical to closely monitor those upcoming proxy votes. The margins for error here are razor thin.
Exactly right. Observers should also keep a very close eye on the transition of insider ownership over the coming months. Particularly, watch how incoming CEO James Heckman manages the capitalization table once he takes the reins. Furthermore, pay close attention to the retention of the institutional market makers. The fact that Vanguard still retains over 430,000 shares and that Jane Street continues to maintain a position suggests that despite all the risks we have debated today, the major institutional plumbing of the market remains engaged with this ticker. There's a tremendous amount of complexity still left to unfold as we digest the final S4 filings and watch the operational rollout of the elite journalist network. This leaves plenty of nuance for the market to explore regarding RTB Digital.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!